Now this story, it may ruffle some feathers.
Oh boy!
So brace
this
for
is a
impact.
hot one.
It is what it is. You know, people got mad. I called out Robert Kiyosaki, but all I'm doing is reading articles and giving my opinion. So here's an article that I saw, and I said, you know who likes drama?
Oh,
I like some drama.
girl.
I want drama for your mama.
Girl.
Here's this article. I said, we got to bring it up. There's people that are going to agree with this, and there's people that are going to be like, how dare you? How rude. What is this, Full House? Anyway,
Yeah.
you got something? No. So here,
You okay?
without ruffling the feathers too much, let's get into this story. This is from the Motley Fool. Here are 3 things that legendary personal finance guru Dave Ramsey gets really, really wrong about retirement savings. Dun, 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 dun. Okay, so this article, Brace for Impact, is about to call out Dave Ramsey. Okay? So, about to call you out, dog.
Yeah, I can just see the headline.
Right. So he's a personal finance personality. He's been out there. He's definitely an OG. Remember the OG.
Yeah.
He's an OG in this. And he's got some great advice. No doubt. No diggity, no doubt. He certainly's got some great advice about paying back debt. But this article basically says, you know his advice that he always talks about in retirement planning?
Yeah.
You know all that stuff he talks about investing?
Ruh-roh.
I don't think so, bruh.
Oh, all those
I
phone
don't think
calls.
so, bruh. So they say that he leaves a lot to be desired, and here are the 3 worst pieces of retirement advice that he gives.
Welcome to Watch
Dun, dun,
Mojo.
dun, dun, dun. So number 1, this isn't like crazy controversial, but here they say, you know, he's a big proponent of mutual funds.
Yeah.
And this article goes on to say he's wrong about mutual funds, and you should probably maybe want to look into index funds, ETFs, or just individual stocks. Okay. Dave Ramsey recommends mutual funds over ETFs. ETF stands for Exchange Traded Funds, David, because mutual funds are designed
again,
to be
David.
invested over the long term. It's possible to outperform the market by selecting the right funds. It's a basket of funds, diversified approach. You know, I've invested in mutual funds. I've invested in index funds, dabbled with ETFs, got some individual stocks. You know, sort of personal preference. What I always say, as long as you're putting money in the market and you're giving it a go for the long term and you're not trading while you're drunk, things are going to work out all right. But this article goes on to say, but ETFs can also be invested for the long term too. That Dave Ramsey doesn't agree. So while you have the option of trading them like a stock, that's sort of the benefit of ETFs. If you want to take anything about this, you could sell them like a stock. Hey, I got an ETF. Boom, we're trading. So basically, Dave Ramsey's not a fan of that. He's more a fan of a mutual fund. So you can trade them like stocks, but you don't have to do that. You can also still do buy and hold. What can you also do, David? Buy and hold. What's the famous crypto thing for buy and hold? HODL. HL.
Yeah, I don't know where I know these
Yeah.
terms. I just don't know where you're going with.
Yeah, there you go. Sometimes you're going to guess. Sometimes you're going to guess right. You're something wrong. Basically, they say you don't have to invest in an ETF that just tracks the S&P 500. You can choose a growth ETF, a dividend ETF, or even ETFs that follow specific industries or sectors like marijuana, as an example, or healthcare industries. Bottom line is, they're saying, number 1, it's arguable that mutual funds are way better than ETFs. All right, so maybe you're a mutual fund investor, maybe you're an index fund investor, maybe you're a, target date investor in your 401k. It's all good. This isn't anything crazy. No beef with Dave Ramsey on that.
I was sorry to interrupt because
Yeah.
it'd be like a Dave Ramsey being an old school dude, and it's just
Oh.
like, I like what I know.
Could be.
He's maybe 65. He's not
Yeah, that's a
95.
point.
I don't know. Anyone a year older. That's my impression of Paul too.
Right.
Oh,
Paul's 40.
Yeah, I know exactly.
Wow. All right, maybe that. Let's circle back to the oldness, okay? Number 2, this is what they say Dave Ramsey gets wrong about investing. Dun 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 dun. That you can earn a 12% average annual rate of return, okay? There's basically saying Ramsey's 12% reality is based on simple average returns of the S&P 500, which he reports as 11.6% from 1928 to 2020. This is what I would call inside baseball. We won't get too caught up into it, but something to think about. Simple average returns aren't exactly the most accurate way to measure how your investments perform. So maybe they're saying that 12% return isn't the truth, because on average, the S&P 500 stock market returns about 10%, and after inflation, it might be closer to 8%. All good. They're basically saying, check your math, Dave Ramsey. Check yourself before you wreck yourself. That's on Dave Ramsey. But here's the more controversial one. The first 2 are in investing. And this is where Dave Ramsey catches a lot of slack for all my Dave Ramsey friends out there. He says that you should pay off all your non-mortgage, housing debt before investing for retirement. Basically, Dave Ramsey argues essentially that you should do the following before you start investing. Pay off all your debt except for your mortgage, all of it. Yeah. Credit cards, car, student loan debt is sort of
high interest stuff, maybe.
Certainly high interest, but he's also saying low interest.
Everything.
Except pay it all off, except your mortgage.
Okay.
The controversial one is your college, college loan.
That's
because
sometimes more than your mortgage.
The amount might be. No, your college loans aren't necessarily more than your mortgage. Maybe, probably.
Depends on where you're going.
Hopefully not. But a lot of times your college loans might be closer to 4, 5, 6%, and the stock market returns, closer to 10%. All right, so they're saying that's what he says to do. But here's the problem. We talked about earlier on the show that it might take you 20 years on average to pay off your college debt.
Yeah.
So you're going to wait 20 years until you're in your early to mid 40s before you start investing. That's sort of the exact opposite of what you should do if you want to have that compound interest on your side. Compound interest, eighth wonder of the world. So basically what they're saying is during that time, you'd be missing out on all your employer 401k matches, which is literally free money, by the way. If your employer offers a 401k, take that shit with the match, okay? Because you'll be losing out a chance to earn returns in the stock market. So you should absolutely prioritize debt and saving for emergencies, no doubt, but not necessarily at the expense of your retirement funds. So essentially, you don't risk free money from your 401k and your IRA to pay off debt. You use money you have to make those debt moves. So basically, they're calling them out. They're saying, look, Dave, here are 3 things you're getting wrong. Your whole love affair with mutual funds, maybe not so much. Maybe that's not the best approach. Maybe ETFs or index funds are better. I challenge you to a duel over this. Number 2, I think your math is kind of off. 12% seems aggressive. They say, future returns are not based on past performances, are not indicator of future returns. All that.
Yes.
So he's saying, no, they are. There they are. And the number 3, that you should pay off all your non-mortgage debt before investing. So here's my take on Dave Ramsey.
My 2 cents.
Here's my 2 cents. Okay. You said he's the OG. Right?
Yeah,
You said
sure,
OG.
He's an OG.
He's an OG,
Could be biased.
So you know what OG stands for?
I mean, I know this.
OG stands for original gangster.
Yeah.
Okay, so in the personal finance space, he's certainly the original gangster. But you know what OG could also stand for?
Oh, boy. What? Old guy?
Old guy. Old guy.
Old gangster?
Maybe an old gangster. Yeah, what's your Dave Ramsey voice? Let's hear it.
I don't like any. I don't know what's going on, but I don't like it.
Get off my lawn. Right? So look, bottom line is I have immense respect for Dave Ramsey. He's actually one of the, my motivators. I see what he's doing. I'm like, all right, cool. It's dope. I can kind of do something like that, but something a little bit more for me. But basically what this article is saying is essentially, look, everything he says is not the gospel. So do with it what you will. For my Dave Ramsey friends out there, we're still friends. For my Dave Ramsey detractors, you're entitled to your opinion, but respect to Dave Ramsey. But bottom line is, pay off your debt, save that money, start investing.
Talk is money, all we talk is money.
If you enjoyed that short clip from the Soscast, click here to watch another, click here to watch the full episode, or just stay broke.